The UK tax system is purposefully designed in a way that prevents you from becoming rich, but there are things that you can do to legally pay less money to the taxman and keep more money in your pocket. If you're new here, I'm a qualified accountant with 10 years experience working in tax, advising some of the largest UK companies on their tax affairs. In this video, we'll talk about how the UK income tax system works, how it prevents you from becoming rich, and the two most effective ways that you can significantly reduce your tax bill. Let's get straight into it by covering off how the UK income tax system works. Income tax is the tax that you have to pay on your earnings, whether it's your salary if you're an employee, or your earnings from a side hustle if you have one, or rental income if you're a landlord. Everyone in the UK is allowed to earn a tax-free amount known as the personal allowance, which is set at £12,570. And that means that you can earn that much without paying any tax on it. From there are 3 income tax bands, and the tax rate gets higher as your income gets higher and you fall into those bands. So the first one is the basic rate band, which means you have to pay 20% tax on anything you earn from £12,571 up to around 50k. The next band is the higher rate tax band, which means you have to pay 40% tax on anything from around 50k up to around 125k. And the final band is the additional rate tax band, which means you have to pay 45% tax on anything over around about 125k. A common misconception is that as soon as you get into a tax band, you have to pay that tax on the entirety of your income. So some people might say there's no point trying to earn 60k because then you'll have to pay 40% on your total salary. But that's not actually correct because the tax bands are graduated. So that means that if you earn 60k, your first £12,570 will be tax-free because it'll be covered by your personal allowance. Then you would pay 20% tax on around 38k of your income, which falls into the basic rate band. And then on the final 10k, just under 10k, you would be paying 40% because that's the proportion that falls into the higher rate band. But having said that, the UK tax system is progressive, which means that the more money you earn, the more tax you do have to pay. And it's pretty harsh on high earners. Not only do you have a 45% tax band, which means you start to pay away half of your income once you start earning over 125k, but your personal allowance also falls away as you start earning over £100,000. And that's because for every £2 you earn over 100k, the government will take away £1 of your personal allowance. That means that once you earn over £125,140, you no longer have the right to earn any untaxed income. At the other end of the scale, we have people who are not earning very much, who don't have to pay much tax, and at the same time can claim lots of different benefits. For example, there's universal credit, job seekers allowance, and housing benefit. And clearly this is important for ensuring that people's basic needs are met for food, safety, and shelter. And so what ends up happening is that we have people on high salaries who are pulled back into a middle distribution because of the high amount of taxes they're paying and the significantly less money they have in their pocket. We then have people who are not earning very much, who are hardly paying any tax and receiving benefits, which means that they're being pushed up into that middle distribution, so that we have a cluster of people in a kind of forced normal distribution who are neither extremely wealthy or extremely poor. And so in that sense, taxes and benefits are set up to ensure that most people end up falling into the normal distribution. And so it means that you can never really become wealthy on earned income alone. The two most effective ways that you can pay less tax and keep more of your money are through realised capital gains and dividends, and they are both taxed way more favourably. So what are capital gains? A capital gain is when you sell an investment for a higher price than what you paid for it. And at the moment of sale, the gain becomes realized and tax becomes due. Usually, this type of gain will be on stocks or real estate, but it can also be on the sale of a business. For a basic rate taxpayer, the capital gains tax rate is 10% or 20% depending on the nature of the underlying asset being sold. And for higher rate taxpayers and additional rate taxpayers, those rates are 20% and 28%. So that's much lower than the income tax rates of 20%, 40% and 45%. Capital gains tax and its lower rates benefit the wealthiest people because almost 2/3 of gains that are made are realized by people who are making gains of over 1 million in that same year. A good example of this is Rishi Sunak, who only paid an overall tax rate of 23% on his earnings of 2.2 million last year because most of his earnings were capital gains. Here is a copy of his taxable income over the last 3 years, which is publicly available. As you can see, last year, his gains made up the vast proportion of his earnings at 1.6 million, whilst his income was 330,000. For most people to benefit from realised capital gains and its lower tax rates, you would need to make a plan to divert money from your savings into these types of investments. That would mean living below your means so that you could invest in things like stocks and real estate. I'll leave a link on the screen to a video where I talk more about this. But for most people, replacing earned income with realised capital gains will be virtually impossible because of the amount of upfront capital that would be needed to invest in the first place. So for the vast majority of people, the best option you have to keep significantly more of your money is to become a company owner. HMRC will tax you to the hilt if you are an employee, and there's not much that you can do about it. You can pay into your pension and you can make charitable donations and they can help to reduce your tax bill. But really, the UK tax system is set up so that it's companies and their shareholders who get to pay less tax. But to be clear, you don't need to own a multi-million-pound business to get the benefits of less tax through corporate structures. You could just operate your side hustle through a limited company. And by doing that, you'll end up in a way more favourable position than if you had continued to earn all of your income as a salaried employee. For instance, if you made 60k as an employee, you would pay around 12k of tax on that and you'd be left with around 48k to spend as you wish. But if you'd earned 60k in a limited company, you would have your 60k of earnings, but then you'd be able to write off any business expenditure against those earnings. So that could include your laptop, other equipment that you use in your business, and motor running expenses, for example. You would then likely be left with a much less taxable income. And then on top of that, corporate tax rates are lower than income tax rates. So at the moment, the corporate tax rates are between 19% and 25%, depending on the level of profits that your company makes. And then say you want to take the money out of the business because you want to spend it on personal things. You would then be able to choose how you take the money out of the business. So instead of taking it out as a salary, you could take it out as a dividend. And you would do that because dividend tax rates are much lower than income tax rates. The dividend tax rates are 8.75%, 33.75% and 39.35%. Those are much lower than the 20, 40 and 45 that we spoke about earlier. The tax benefits of corporate structures are a major reason why the vast majority of the Sunday Times Rich List top 20 are corporate shareholders. And the salaries that these individuals earn through their corporate executive positions at these companies will only be a small percentage of what makes up their total earnings. The rest of their income will come through dividend payments and the value of their shares increasing over time. If your goal is to build wealth and to keep as much of it as possible, then one of the best things that you can do is to reduce your reliance on traditional employment. Of course, this won't suit everybody because it depends on your risk appetite, the goals you have, and the type of work you want to do. Some people might love their careers and also love the reliability of a monthly paycheck and knowing how much is coming in. And that security will be the most important thing for a lot of people. But it's the reason I moved away from salaried employment to work for a startup where I also have an equity share. The risk is higher, but so is the potential reward and the opportunity to keep more of my money. If you learned anything from this video, then please do subscribe to the channel. It would mean the world to me because it really will help my channel to grow. Thank you for watching, and I'll see you next week.